India-US Double Taxation Avoidance Treaty. Same income of any person. The word person as defined in Income Tax Act, it can be individual, HUF, firm, company, any person as defined in Income Tax Act. The same income of a person is taxed in two countries. Then we may have to resort to Double Taxation Avoidance Treaty agreement, if any. India is having Double Taxation Avoidance Agreement treaties with many countries. Where Double Taxation Avoidance Agreement treaty is there, we also have to refer to Section 90. Section 90 of Income Tax Act, where there is no treaty between India and another country. Suppose Indian government wants to give relief to avoid double taxation of the same income, then we have to refer to Section 91, that is Unilateral Relief. Relief is given by Indian government by self. Now let us take an example. A person, an employee of an Indian company, residential status of the company and residential status of the person, the employee. We are talking about the employee. He is working in some MNO company. The person is a resident as per residential status, as per income tax laws. The person is a resident in India. On employment, he goes to United States. Now, United States, he may get PDM, that is per diem allowance. He may get so many other benefits, and he also get a fixed sum there in terms of dollars. Let us say he is earning $5,000 a month or $10,000 a month. He is getting Indian salary. He is also getting salary in US, that is $5,000 or $10,000 a month. Let us say $10,000 a month. Indian salary anyhow is taxable in India, no doubt about that. Now the question is, if we observe, he is a resident of India as per residential status, as per income tax laws. Now, he is getting income. His income is accruing and arising. His income is arising and accruing in United States. That is $10,000 a month. He will stay there for, let's say, 3 months. So he has earned $30,000 and he will come back. He continues to work in India. So $30,000 he has earned while he was in US. Now, income arises and accrues in the place where services are delivered, services are rendered. Now, in this case, the services are rendered in United States. So, income arises and accrues in US, and any income arising and accruing in a particular country will be taxed in that country. In this example, the person, the employee, as per residential status, is a resident of his domicile, his residence is in India. Whereas his income of $30,000, to the extent of $30,000, is arising and accruing in United States because he has rendered services in US. Now, as per scope of taxable income in India, a resident of India, if the person's income is accruing anywhere in the world, is taxable in India. As per the provisions of Income Tax of India, scope of total income, wherever the income of the resident is arising and accruing, it is taxable in India. So based on his residential status, domicile, the income of $30,000 is taxable in India. But it is also taxable in US because it is arising and accruing in US because the services are rendered in US. So the same income of $30,000 of the person, in our example the employee, is being taxed twice in two countries, India and United States. So wherever double taxation is there, taxation more than in one country, we have to see whether there is any bilateral agreement backed by section 90 of Income Tax Act. Now section 90 of Income Tax Act and bilateral agreement treaty, when we read together, if the treaty says any income of a person, if the person is a resident of one state, the word state is used in double taxation treaties. The word state has to be understood in terms of country. In common parlance, we normally use the word country or a nation. In double taxation treaties, the word state is used. Now, if the double taxation treaty, let us see the treaty. If the double taxation treaty says the income has to be taxed in the place where the person is resident, if it says like that, then it is called tax exemption method. That means it will be taxed in the place, in the state, that means in the country in which the person, employee, is a resident. Here in our example, the person is a resident in India. So it will be taxed only in India. It will be exempt in US. If the treaty says so, that is tax exemption method. Suppose the treaty says, Indo-US treaty says the income has to be taxed in the place, in the state means country, in the state in which services are rendered. In our example, services are rendered in United States, so it is taxed only in United States. Suppose the treaty says so. So it will be taxed in United States, it will be exempt in India. This is also tax exemption method. This is again tax exemption method. Full exemption method is there, partial exemption is there, possible. Suppose the treaty says 60% of the income is taxable in the place where the person is resident, in the state where the person is resident. 40% of the income is taxable in the state where the person has rendered services. If the treaty says so, we have to see the text of the treaty. If the treaty says so, then the income to the extent of 60%, that is $30,000 in our example, to the extent of 30,000 into 60%, it will come to 60 to the $18,000 will be taxed in the state in which he is a resident, that is, it will be taxed in India to the extent of 18,000. To the extent of 40%, as per the treaty, it will be taxed in the state where services are rendered, that is in US. That is $30,000 into 40%, that will come to around $12,000. So in our example, $12,000 will be taxed in the United States. So this is partial exemption method. That income is not completely exempt, taxable in one country and completely exempt in another country. It is not like that. That is full exemption method. In full exemption method, it is taxed only in one country, another country it will be completely exempt. In partial exemption method, it will be taxed to a particular extent in one country, to a particular extent in another country. It also means it is partially exempt in one country, partially exempt in another country. So that is full exemption method. Full exemption method, partial exemption method. This is an example of tax exemption method. Now, tax credit method. Suppose the US and Indo-US treaty says, or any of the bilateral treaty says, tax has to be paid in the country in which services are rendered, but credit can be taken in the country in which the person is resident. If it says like that, then it is called tax credit method. So in this example, what happens, if the treaty says so, for the $30,000 income, in our example, the person has to pay taxes in United States because services are rendered in United States. They will withhold the taxes and pay the amount of remuneration. So whatever taxes are paid or withheld, whatever taxes are deducted, withheld or paid, the credit of that can be taken, a deduction for that, a credit for that, a deduction for that can be taken while paying taxes in India. So in our example, the employee has various heads of income in India. On that so some amount of X amount of tax payable will be there. In that, we will deduct TDS, we will deduct advance tax, we will deduct self-assessment tax, we will deduct all list of things. Along with that, we will deduct whatever tax is paid by the person in the foreign country. The balance tax only will be paid. In that, some small formalities are there, that also we have to see. So this is an example of tax credit method. In this example, let's say in this example, it is not fully exempt, it is not partially exempt. Is it fully exempt or partially exempt? Whatever income is there, $30,000, the tax is paid in US. Okay, let's say there the tax rate is 40%. US has got state tax as well as federal tax. In India, we have one single income tax, whereas in US there is state tax, state income tax, and federal income tax. Now both put together, let us say it is coming to around 35%, or let us say 40%. Just for our example's sake, let us say 40%. Now in India, the person's average tax rate is coming to around, let us say, 25% or 30%. Now he has paid higher taxes than what is payable in India. So in India, we don't have to pay anything. Suppose their federal tax and state income tax put together, it's coming to, let us say, 30%. And in India, just for example, we are paying, let us say, 33%. 30% is already paid there in US. In India, we have 33% average rate, let us say average rate of tax for that employee. Now that 33% minus 25%, balance tax only has to be paid. So this will come under small formalities, some calculations are there that we have to see. So basically, concept wise, this is tax exemption method or tax credit method. In tax exemption method, what will happen? In full exemption method, the tax will be paid on the income only in one country. Another country it is completely exempt. In partial exemption method, the tax is paid to particular extent of income in one country to particular extent of income in another country. In other words, it is exempt to particular extent in one country to particular extent in another country. So entire income is only taxed once. In tax credit method, there is a light difference. The entire income is taxed in one country. Another country, depending upon which tax rate is higher, country A and country B, or in India and US, where it is higher, that tax will anyhow be paid. In our example, if tax rate is 40% in US, federal tax and state income tax put together, and no further tax will be paid in India. Whereas, suppose their federal state income tax and federal income tax paid in US is coming around 25% or 30%. Normally tax rates will be higher in US. So let's say 30%. In India we are paying 33%. So 33 minus average tax rate minus this US tax rate. Balance tax only will be paid. So this is backed by section 90 of income tax. Section 90, wherever double taxation treaty is there with any country, where double taxation treaty is not there with any country, then we have to see unilateral relief under section 91. It is similar to tax credit method. Suppose the country is, India is not having a double taxation treaty with that particular country, then India by itself may give credit for the taxes paid in another country. Calculation is similar to tax credit method. Now, another question that arises is, should we go for section 90? Wherever bilateral treaty is there, section 90 will be coming. Section 90 of Income Tax India. Should we apply section 90 of Income Tax Act? Should we apply provisions of Income Tax Act? Or should we apply the provisions of a bilateral treaty? Let's say there is a contradiction. Indian income tax provisions as well as section 90, and if we read the treaty, there is a contradiction. Let us say, wherever there is a contradiction, whichever is more beneficial to the assessee, we have to apply. That is given in section 90 subsection 2. If there is a conflict or contradiction between provisions of section 90 of Income Tax Act India and bilateral treaty, double taxation avoidance agreement, double taxation avoidance treaty, whichever is more beneficial to the assessee, that we have to apply. That is section 90 subsection 2. So see, basically how it works is, why section 90 subsection 2 says so. If Indian income tax provisions only have to dominate the situation, then purpose of entering a double taxation treaty with a foreign country will be of no use. The purpose will be defeated. The objective of entering into double taxation treaty or bilateral treaty is to give benefit to the assessee. So whenever we are reading a section, first we have to try to understand the objective of the section, why the section has been introduced, why the section has why the law has been passed, why the section has been written. That is constructive interpretation of law. Many a time, if we restrict ourselves to literal interpretation of law, then we may just spend our time in interpreting in hundreds of ways. Our objective is not interpretation. Our objective is to understand the objective of the law. Our objective of interpretation should be to understand the objective of the law. And it is always preferable to go with constructive interpretation, harmonious interpretation. Restricting ourselves to literal interpretation, letter of law, whatever is printed, whatever is there on print, If we restrict ourselves, then it will end up in litigations. Finally, even if we go to Supreme Court or in international court, objective of law only will prevail. Plethora of cases may not even go to courts. Writ petition may not be filed if the intellectuals give preference to understand the objective of law and give effect to objective of law.